Hello everyone, my name is Igor Hnatko. I am the partner principal here at Bosker Accounting. I'm a chartered accountant and I would just like to talk to you about financial versus managerial accounting. This is something that a good colleague of mine recently has asked me to think about and sort of prepare for his members. I'm talking here about Paul Crusp of Kinaway Chamber of Indigenous Chamber of Commerce here for Victoria, and he basically said that his members, when he asked them to say, when he asked them, do you have your financials done? They say yes. But then he asked them, do you have your management accounts done? And invariably they say, well, no, or we don't produce them on a monthly basis. We don't have specialized reporting because their accountants are either not equipped or they just don't see, I suppose, the value, not to the client, but to themselves in providing that type of service. So I'd like to just compare the two. They're both important. And the reason why they're important is one will get you in the good books with which is financial accounting, with your regulators, with your bank, with your external stakeholders, and the other, which is your managerial accounting, will get you in the good books with your wife, with your partner, because your business will be well looked after. We all know the old adage of failing to plan is planning to fail. So without further ado, and I will do this in this manner, I will explain what the financial accounting is first, and then what managerial accounting is second. So just bear with me. So financial accounting, as we all know, talks about reporting to the tax office, to your external stakeholders, to your bank. So you are reporting on aggregated basis. Aggregated basis basically means you're reporting on the whole of your business without splitting it. You are also looking at the efficiency. So the bank and the tax office and your potential investors will want to see your financial statements. They will compare your business to those listed on the stock exchange to see the return on investment, to see return on assets, the utilization, things like that, efficiency, basically, what the profit is at the end of the period, and how it compares to other businesses, because the financial statements really are supposed to help the investors allocate limited resources, which is money. We all know that it's limited to what you have in your bank, obviously. But so let's get back to it. It's based on the proven information. So your bank statement, your loan statements, what is it that you have submitted to the tax office on quarterly BAS statements or monthly installment activity statements. So all that is verified by the tax office once you lodge the tax return and provide the financials. We were talking about the reporting focus. So the reporting focus here in financial accounting is geared towards the end of year data. It's geared towards creation of financial statements at the end of the year, and looking at all the other parts in the balance sheet to verify them and to make sure that they're correct. The other one is standard. So all the financial statements, all the accounts in Australia and around the world are prepared according to the international accounting standards, and that's been accepted in Australia as well. So there is no getting away from that for financial accounting. Systems. In terms of operations and how the business is run, financial accounting really doesn't care about your systems. It just reports on your profit, cost of goods sold, if there is any, if you're a retailing business or a hospitality business. But if you're a services business, there is no cost of goods sold except for the time. Time period, again, a reporting focus here plays a part. So the time period is usually yearly. And if you're in different jurisdictions, you might have to prepare the financials for those jurisdictions as well. And timing as well, once a year. The other one is valuation, and that's according to the standards. So you're looking at the assets and liabilities and the valuation and impairment of those according to the tax laws and according to the approved international accounting standards. So on that basis, financial accounting is basically pretty much looking back at what has happened, because it's geared to providing financials, let's say at the 30th of June, if that's your reporting period, but you can only start doing that sometime in July. So how does this compare to managerial accounting or management accounting? For aggregation, for example, managerial accounting is detailed. It is either done by product class or product category, by geographical region, and it's reported to internal stakeholders only, so to your divisional managers or to your geographical managers or general managers in your business. Whichever way you want to really organize your business, you can report on it in managerial accounting. In terms of efficiency, we're talking here about specifically what is the problem or issue in the business. So you are looking at perhaps some of the non-financial data even being included here, from your marketing pipeline to your sales pipeline to your conversions to your churn rate, and ultimately conversion into the sales, so into the income figure. And you're looking at what is your cost per getting an inquiry, what is your cost per reaching out to a prospect. So in order to do that, we use estimates. Obviously, we use ratios as well to identify the bottlenecks and the issues in your company as well, in your business. So once you start tracking those, you can start reporting on those. And again, in financial accounting, your reporting is once a year. In managerial accounting, it is as often as you need it. Obviously, there is a cost associated to that, so there's a cost-benefit analysis to be done there. But in reality, you are looking at the difference between, middle of the month running out of funds if you are not monitoring your cash flow correctly, if you're not monitoring your supplier payments, as well as the income coming in. So on that basis, looking at the managerial accounting and reporting on monthly basis, or having the budgets as well as forecasts looking forward rather than back, is crucial for any business. So it also looks to identify bottlenecks in the business, and to look at your utilization of your assets. In financial statements, we had impairment of assets. Here is more utilization of assets. What is your, that key asset that you have in your business? What is its utilization? How are you using it? Can it be improved? And the ways of improving those. So I would say the most important part in your business is to plan and to do a budget and to do a forecast. And this will set you for that year. Not to say that you can't review your budget and your forecast. By all means, it is a living document. So it's not just enough to, at the beginning of the year, identify your goals and what you have to do, but during the year, maybe you have already surpassed those goals. Maybe the gap that you identified was easily surmountable. So why not look at your budget, look at your financial forecast, or your forecast, and then plan for that next thing. So this would be my takeaway. It is crucial. It is something that your partner and your family will thank you for, which is why we all do, which is why we're all in business, really. is to improve our lives and lives of those that work in our businesses and our customers and our clients. We really have an obligation to them to service them the best that we can. So that's it for me. I'm here. I am listening. In the words of Fraser, I am listening. So please leave your comments and what you think of this first video. And I'm here to answer any of your questions, also to help you with your business. If you need me to have a look at something, feel free to reach out to me. I am happy to help. And yeah, that's about it for now. I'll talk to you soon. This is Igor from Bosker Accounting. Thank you. Bye.